In Chapter 11, we're looking at accounting for corporations. And what we're really going to be concentrating on is stock, because if you remember from the very beginning of this class, a corporation is the only type of company that we've studied that actually has stock. So we're going to spend Chapter 11 really getting an understanding of stock. And first we're going to start by looking a little bit more deeply into the characteristics of corporations. In the very beginning of this class, say probably chapter 1, maybe chapter 2, we looked at some of the basic characteristics of all different types of companies, including corporations, but now we're going to look at it a little bit more closely. So a corporation is a separate entity. It is an entity that is separate from its owners. So that would be if you compare that to a partnership or a sole proprietorship. Those things are not necessarily separate from its owners, meaning if one of those owners dies, passes away, decides to no longer run the organization dies with it. However, a corporation is different because it is a separate entity, meaning it's separate from its owners. So if one owner decides to leave or no longer hold any type of ownership in the company, or if a stockholder dies, it really doesn't matter to the existence of that corporation because it is separate from its owners. A corporation is an entity that is created by law, so there's a lot of regulations around being a corporation. There are rights and privileges for a specific corporation, talking about what it can and can't do, but there's also some downfalls related to those rights and privileges that we'll start looking at the next slide. So the ownership of a corporation, we've mentioned this before, but if you own a corporation, you are a stockholder. There can be many, many, many different stockholders, or there could be just a few. But for each share that you own that small proportion of the company. You could own one share of stock, say, in the Apple Corporation, and you would be one of very many. You're just kind of a drop in the bucket. So if you decide to sell your share of stock, or, unfortunately, it would be sad for you and for your family and friends, but if you died, or if I was this one owner in this Apple share, if I died, Apple does not cease to exist because Apple Corporation is separate from my ownership. So we can also talk about privately versus publicly held. Typically, when you talk about a corporation, you think of a public company, meaning that it's traded on, say, the New York Stock Exchange. However, we can have both privately held and publicly held corporations. Either way, even if it's privately held, it's still a corporation. But what we're talking about is who owns the stock and who is able to own the stock. If you are publicly held corporation, this is a corporation like Apple, Nike, Coke, any type of large corporation that is traded on your basic stock exchanges. On the other hand, you can have a privately held corporation. So this is a corporation. It can still be a very large corporation. We're not talking about size here. But rather than being able to have anyone purchase your ownership or purchase your stock, it's only going to be held by a certain private group of people. Typically, a privately held corporation is a family-type business. For example, I'm trying to think, I used to audit Brown-Forman. Now, Brown-Forman now is more of a publicly held company. However, there is a large proportion of their shares of stock that is only held by the Brown or the Forman family. So that portion of it is privately held. In the past, it was fully privately held, but it has slowly become more of a public company versus private. Another example is if you think about regional type banks. Oftentimes, regional type banks, they are corporations, but they are privately held. Why would you want to have a privately held corporation over a publicly held? It's all about ownership, and therefore who has the power to make decisions for a company. So if you want to keep the power within your own family or within a certain group of people, you would have a privately held corporation where you only buy and sell stock between that private group versus a publicly held corporation. So when we talk about corporations, there are lots of advantages, but there's also some major disadvantages that we'll talk about. We've already talked about the fact that the corporation is separate from its owners, meaning that the life of the corporation is not limited by the life of its ownership. Also, if ownership wants to change, it's not going to be a big deal to the corporation. Limited liability of the stockholders. Let's talk about this in comparison to, say, a sole proprietorship. If you own your own business and you make a big mistake and that mistake hurts someone, you as a sole proprietor could be sued. On the other hand, when you look at a corporation, you have a limited liability for your stockholders. So if you think about, let's say you own one share of stock in Apple, and let's say Apple does something and for some reason they're sued. You as an individual cannot be sued because you have limited liability. So your liability or the money that could be sued is limited. Now, the value of Apple may decline because of a very large lawsuit, so you could lose a little bit of the value of your stock, but you as an individual cannot be sued for, say, your personal home and things like that. Whereas a sole proprietorship, if the company or your business cannot pay for a lawsuit, that person with the lawsuit can then come against your own personal home or car or your own bank account, because a sole proprietor does not have limited liability. We've already talked about the transferability of ownership rights. This is just talking about how it's very easy to buy and sell stock. So you can invest in a company, and if you change your mind, you can sell it. So it's transferable. Continuous life, again, that goes along with the fact that it's a separate entity. It's not tied to the life of its owners. There's a lack of mutual agency for the stockholders. What does that mean? Think about it again. If you're that one person, you own one share of stock for Apple. Do you think that you as an individual, because of that one share of stock in Apple, should be able to make decisions for what Apple does on a daily basis? No. Because who runs the company? Management. Those are the people who should be making these day-to-day decisions for Apple. So, you as a stockholder have what we call a lack of mutual agency, meaning that you as a stockholder, you cannot make binding decisions for the company. Now, we'll talk about some rights as stockholders in a minute, and one of those rights is the fact that you can, we have voting rights as stockholders. However, that comes into voting. There would have to be a majority to make particular decisions. But when we're talking about day-to-day decisions and contractual obligations, you as an individual stockholder cannot do that. Then, the major advantage of being a corporation is the ease of capital accumulation. Okay, what that means is that capital, we've talked about in this class, is money. You can easily accumulate capital, meaning you can easily raise money. How do you do that? Once you're a corporation with a certificate of incorporation, you can sell stock. Why do you sell stock? You sell stock in order to bring money into your company. So once you are incorporated, I'll say it's fairly easy to raise capital. Now there's lots of regulations around this, but you can raise a lot of capital fairly quickly as a corporation, but you have to be set up as a corporation first. Then let's talk about some disadvantages. There's a lot of governmental regulation. So think about you as a stockholder. If you're investing in Apple, you want to make sure that Apple is telling you the truth about what is going on in their company, because that's how you're making your decision about whether or not you're going to invest in the company. So our government steps in. This is where you hear about the SEC, the Security and Exchange Commission. They are going to regulate the different companies that are sold on our various stock exchanges. So some of these regulations include that they have to follow GAAP. You're going to be audited every year. Every quarter, you're going to at least have to have a review. You're going to have to comply with Sarbanes-Oxley and all of the different provisions from that. So there's a lot of governmental regulation, and it's expensive. In addition to these basic governmental regulations, once you're already a corporation, there's also a lot of regulations and legalities and money involved when you're becoming incorporated. There's a lot of expenses there and a lot of legal processes that you have to go through in order to become incorporated. Finally, we'll talk about corporate taxation. When you talk about a corporation, we talk about what we call double taxation. And the double taxation is not necessarily on the overall income of the corporation, but the double taxation is double tax that is realized by the owners or the stockholders of that company. So let's think about this. Any company that earns money in the United States has to pay income taxes to the IRS for the United States government. So a company is taxed on their income. Then, if you are a stockholder and you earn dividends from a company, you are also going to be taxed on those dividends as part of your personal income tax. So you as an owner not only has the company that you invest in and therefore have stock in, not only has that company been taxed, but also when you get a dividend from that company or when you sell your stock, you're going to be taxed as an individual. So there's a type of double taxation there. So let's look at the basic organization of a corporation. On the top here, you can see stockholders. Stockholders are the owners of the company. But again, think about yourself. If you own one share of stock, do you think you should run the day-to-day activities of Apple? Are you intelligent enough about what is going on day-to-day at Apple Corporation in order to make managerial decisions for them? No. So, because stockholders are not working right there at the companies in which they're investing, stockholders have had to find a way to properly run these companies that they have a share of ownership in. And this is how it's done. Stockholders vote on what we call a board of directors. The board of directors are elected by our stockholders, and that's through some of these voting processes that I mentioned before. And then it's the board of directors who then goes and they hire a president, a vice president, and the other officers for our board. Then we have these people who actually are going to hire the employees of the corporation. So through the stockholders, we are electing the board of directors and therefore the president, vice president, and other officers. And then it's through these people that the employees of a corporation are hired. So the manager of the corporation and all of the people who actually run the day-to-day activities, these are the people who make decisions for the company, but as you can see, it is all under the control of whoever owns the company, which in the case of an organization that is a corporation, it's going to be all directed by the voting power of the stockholders. So even though the stockholders don't have the day-to-day activity or knowledge of the activities that go on, they do have the power to elect, and then through those elected members hire the people that actually run the control. So you can see here the stockholders have ultimate control, and they typically meet once a year. As a stockholder, you're not required to meet. Typically the only people who do meet are the people who own the most stock, but you as a stockholder could be part of this meeting. You would be invited to vote via proxy statement, so this would be like mailing in your vote on important decisions. You would then elect our board of directors, and these are the people who have the overall responsibility for managing the company. And they do that by hiring the people who run the company on a day-to-day basis. So I mentioned that stockholders vote, and they vote at stockholder meetings if you go to the meeting, or you can register to vote via proxy, which would be just an electronic or mail type vote. So this is a right as a stockholder. Now, as we move forward, we'll begin to look at what we call common stock and preferred stock. So there's actually different types of stockholders. And depending on the contract or your stockholder certificate, different types of stockholders have different rights, particularly when it comes to voting. As we move forward, we'll look at the benefits of being a common stockholder versus a preferred stockholder. But since we're talking about voting now, I'm going to go ahead and tell you that typically common stockholders have voting rights, whereas preferred stockholders, even though they are preferred stockholders, they typically don't have the same voting rights. Now, there's another reason why they are preferred, but we'll look at that when we get there. So as a stockholder, you can sell your stock if you'd like to. You can purchase additional shares of stock if you want to continue investing. You have the right to receive dividends. Now, this is not the promise to receive dividends, but if dividends are declared, you have the right to receive your equal share based on how many shares of stock that you have. Then you can see that if a company were to liquidate, therefore it was going out of business, you would be able to share equally in the assets that remain after any type of creditors are paid out. So what we're talking about here is if a company decides to liquidate, meaning they want to cease being a company, the first thing that you have to do is you have to pay out any of your legal obligations. So, for example, if you had notes payable, bonds payable, any of those legal liabilities, you have to pay those off first. And then, if you have any money or assets left over, these are going to be shared amongst your stockholders. And it says that they would be shared equally. It's not necessarily everyone's going to get an equal slice of the pie, but you're going to get amount equal to the proportion of shares of stock that you own. So these are some basic rights of stockholders. Here's just a typical example of a stock certificate. When a stock is initially sold, you get a share or a stock certificate. But if you're going out and you're purchasing stock on the New York Stock Exchange or wherever you're purchasing stock, you're not going to get a specific certificate for every share of stock that you buy. Typically, when people purchase stock, they're doing it through a large trading type bank. So, for example, TD America. And so they're keeping up with all of the information that holds up your stock. But you're typically not going to get a stock certificate unless you're part of the initial public offering, which is the first time that stock is sold. So a couple basics about capital stock. Capital stock is a type of equity, and this is where we've talked about when someone invests money in a company, say $20,000 in return for stock. That is where you would show the cash coming in as a debit, and then stockholders' equity increases with a credit, so you would be increasing stockholders' equity for that common stock of $20,000. So now we're going to take this a step further. You began to see this in the previous chapter, but we're now going to talk about value of stock. So you can see here we have common stock, and we're now told it has a par value. This par value is a bit of an arbitrary value that doesn't have a whole lot of meaning today, but par value is a value that is assigned to each share of stock. Now I want to go ahead and note that par value has nothing to do with market value. Market value is the value that a share of stock is selling on a stock exchange at a given moment on any certain day. So that's what you would see reported on the nightly news when you're seeing that Apple went up, 2 points, or Nike or whoever went up or down. That's where you're talking about the market value. So in this case, we have common stock at par value, and you can see here that a company is authorized to sell 250 million shares. So this means that when this company became incorporated, meaning that they went through all the regulations to become a corporation, they were authorized to sell this many shares. Now, it does not mean that they have to sell these, but this means this is the limit to which they were authorized to be able to sell. Then you see here that we have shares that are issued and outstanding, and it's only about 92.5 million. So although this company is allowed to share to sell 250 million, they have only at this point issued about 92 million. So this is of these possible shares, this is what they have sold in order to raise money. And so the difference between these are additional shares that they could sell at some point in the future. Now when we say issued and outstanding, if you issue a share of stock, that means you sell it to your stockholders. As we get further along in this chapter, we'll also learn that companies can purchase their own stock from the stock market, and we call this treasury stock. So stock that is issued is stock that has been sold to stockholders, if it is still outstanding, so if you say it is issued and outstanding, that means this is stock that has been sold and is in the hands of your shareholders. If it is no longer outstanding, that means that a company has purchased it back, so they have purchased it from the public and they are holding it for their use. We call this treasury stock. Why would a company want their own stock? Maybe they want to regain control. They had too many stockholders who were gaining control of the company and they want to have that control back for some reason. Or typically what you'll see is some of the higher ranking people in a company, instead of just getting straight compensation or salary, they're also given what we call stock options as part of their payments and benefits. In order to issue stock options to your employees, you have to have that stock on hand. So you purchase it for treasury stock, and then as you give it out in your stock options as part of your compensation, you would be doing that out of your treasury. So those are just some basics of capital stock. Now we talked about par value on the previous slide, and that's just an arbitrary amount assigned to each share of stock, and that's not to be confused with market price. When we talk about par value stock, we have to look at different classes of stock. So we have par value stock, meaning that there is an arbitrary amount assigned to each share of stock. We can also have no par value, and we'll look at how we record those. It's shown throughout the book and through this chapter. And then you can have a stated value, which is similar. It's just different terminology to par value. Now, what's important about par value or no par value? It simply changes the way we record it. So, if you have par value stock, when you sell stock, let's make it easy. If we have $1 par value stock and you sell it for $20, when we record that, we're going to have two accounts that we need to increase for equity related to that sale. First, the par value is $1, and if we're selling one share of stock, we need to increase the common stock account by $1 because that is $1 par value stock and we have sold one share. But what about the difference between what we sold it for, $20, and the par value, $1? That $19 is what we call additional paid-in capital. And let's talk about that. Remember, when you are selling stock, you're trying to raise money. Another way to say that is we're trying to raise capital. So anything that we sell our stock for beyond the par value is additional capital that your investors have paid into the company. So that's why we call it additional paid-in capital. So now let's look at how we actually record some of these stock-related transactions. This isn't going to be totally new to you, as you've already seen the first part of this. When we issue stock, we have two things that happen. We're going to recognize the cash and then the common stock. What we're adding to this now is this knowledge of a par or a stated value. So let's look at how we do this. We have a company that issued 30,000 shares of $10 par value stock. And when they issued this, they got $12 per share. So let's talk about this. Par value is 10, but they got $12 per share. So the difference, this $2, is going to be additional paid-in capital of $2 for each share issued. So let's go ahead and record this. The bottom line is they get a full $12 per share, so $12 multiplied by 30,000. We're getting $360 of cash. But then we have to separate these when we begin to record our actual equity accounts. So we're going to have our common stock account and then our paid-in capital in excess of par for the common stock. $10 of par value multiplied by 30,000 tells us that the common stock is going to increase by 300,000. Then what remains, $2 per share, because that's the payment above par value, multiplied by 30,000 is 60,000. So that's what's going to go into that paid-in capital in excess of par. Now, a company can also issue stock in return for something besides just cash, and we're going to look at that in a minute. But at this point, I just want to emphasize, you can see here, we are just doing this for cash. Someone has paid us cash, and we are recording it as such with the asset of cash increasing. Here's just a quick picture of an example of what you might see in the equity portion of a balance sheet related to this common stock. So you can see again in the stockholders' equity section, we have the common stock separated between its par value and the excess paid in capital. So you can see here we've got $300,000 and $60,000. And then if you'll remember, equity also includes retained earnings. So we're showing our retained earnings there. And the sum of all of these make up our stockholders' equity. So the paid in capital in excess of par, this is still a type of equity account. It's still a stock-related account, but it's just a different account name. It all still rolls into stockholders' equity. So now let's look at what happens if a company issues stock in return for something besides cash. And in this example, someone is giving land to the company. In exchange for that land, they're going to get stock. The rule here is that we will record whatever asset the company gets at its fair market value. So in this case, that's all they've told us, is the land is valued at $105,000. But if the problem told us that whoever is investing in the company and giving this land to the company bought the land for $90,000, but the land is valued at $105,000, which number would we use? The rule is that we're going to use the fair market value. So if it's valued at $105,000, that person's own historical cost is irrelevant to recording it to the company. So let's look at how we do this. So we're going to be getting land that has a fair market value of $105,000. So this part's pretty straightforward. We're just going to record this as a new asset on our books. Assets increase with a debit, so that's why we're showing the land account being debited. And then let's look what we have here. We're told we have 4,000 shares of $20 par value stock. So the first thing that we're going to do is go ahead and record the par value portion. 4,000 multiplied by $20, that's $80,000, and that's going to go into our common stock account for $80,000. We then have to look at the difference between the par value and the fair market value that we received, and you can see here that's $25,000. So this $25,000, what's required to make everything balance, that is the additional paid in capital. So that's what we're going to put in this paid in capital in excess of par account. Now we're going to begin to look at payments that can be made to investors in a company. And we're going to begin with just your basic cash dividend. A cash dividend is just when money is paid to stockholders relevant to however many shares of stock that they own. So dividends can be fairly small. They could be, say, 1 penny for every share of stock, or they could be larger. Maybe you could get $1, $3 or so, but it's in proportion to however many shares of stock that you own. So let's look at a little bit more detail here. So a cash dividend is just a payment made by the corporation to the stockholders. When we account for cash dividends, there's 3 important dates here. We've got the date of declaration, the date of record, and the date of payment. Now, if you think about the overall stock market, stock and shares of stock are trading over and over on a daily basis. So that's why we have this need for date of record. The date of record is the date that you have to own the stock in order to get your money, or in order to be eligible for the dividend. So let's talk about this. Let's say on January 1st, a company decides that they are going to pay a dividend. Now, there are lots of shareholders on record. There's a lot of people that have this stock. So they're going to go ahead and announce that they are going to declare and pay a dividend in the future. It might be 1 month in advance, or it might be 2 or 3 months in advance. But the bottom line is that they're saying that we are going to pay a dividend. As soon as you declare a dividend, this is just saying that we are going to pay a dividend, you have now entered a legally binding contract. So at that point, you have an obligation to pay the dividends. So it's at this date that we will record the liability for the dividend, and we'll look at that entry in a couple slides here. Then what we have to say is who gets the dividend, because if it's January 1st and we're not paying until, say, March 31st, March 31st would be the date of payment, who gets the stock? The people that had it on January 1st or when you actually make the payment? Neither of those. What they do is they establish a particular date of record and say whoever owns the stock at this point in time will get the dividend. So let's say maybe the date of record is January 31st. So then the company will look at who owns the stock on January 31st, and at that point they will issue the dividends to those people. So those are the people who are going to get the dividends. The date of the payment is the actual day that the payment is made. So the cash leaves the hands of the corporation and it goes to whoever was a stockholder as of the date of record. So the date of record we said was January 31st. Nothing needs to be done on January 31st. We have an entry when we have our initial liability, and then we have an entry when we actually make our payment sometime down the road. And when we make the payment, we'll get rid of the obligation and show that we've fulfilled that by paying cash. So let's look at these. On January 9th, a $1 per share cash dividend is being declared on 5,000 common shares outstanding. The dividend is going to be paid on February 1st to stockholders on record as of January 22nd. So first, let's go ahead and record what we need to record on the date of declaration. So the date of declaration is when we as a company promise to pay a dividend. So in this case, on January 9th, we need to show this new liability. We're showing that by increasing this common dividend payable account. This is a new account, but it's a payable account. It works just the same as any type of liability account. It increases with a credit here. And then I'm going to emphasize what's going on here with retained earnings. At the very beginning of this course, we began to talk about expenses and dividends and revenue and things like that. The one thing that is very important is that you never confuse a dividend with an expense. A dividend is not an expense. It is a reduction in retained earnings, because if you'll remember, by definition, retained earnings is the earnings or the net income that a company makes from year to year that company is retaining or keeping inside the company. So this is money they have earned and they have kept. They have not invested it. It's just money that they have kept in the hands of the company. So if you're not keeping this income, what are you doing with it? You could be paying out a dividend. So when we pay a dividend, it reduces our retained earnings. If you'll remember, based on our basic accounting equation, retained earnings is a type of equity account, and it increases with a credit. If you'll remember, revenue also increases retained earnings. So revenue is also on the credit side, and that's why expenses are on the debit side, because an expense would decrease retained earnings. That's the same as with a dividend. Dividend is a reduction in retained earnings, so don't make the mistake of recording it as an expense. Instead, it goes straight to the retained earnings account, and we're showing that reduction by debiting retained earnings. So we have now reduced retained earnings for the amount that we're going to pay out, or for this money that is no longer going to be retained in the company, and we're showing that we have a payable. Then we have our date of record, and that's just going to say whoever are the stockholders as of January 22nd, these are the people who are going to actually get mailed a check on February 1st. So now let's actually record this payment on February 1st. All we're doing here is we're paying out cash. So it was $1 per share, $5,000 of cash going out the door. And we fulfilled that obligation. We promised to pay a dividend, so we had a payable. But now we have actually fulfilled that promise and we have paid that dividend. So we're going to get rid of the payable here by debiting that payable or that liability account for the full amount, because our obligation is fulfilled. So if you'll remember, a dividend is a reduction to retained earnings. So let's look at what happens here. Sometimes a dividend can be paid out that creates a negative effect in retained earnings. You can also have a negative balance in retained earnings if you're a company that has had significant losses, because remember, retained earnings is made up of your net income, or if you're incurring losses, it would be a net loss. So what does it look like on your stockholders' equity section of the balance sheet if you do have a deficit? You can see here everything's recorded the same, but rather than showing a positive amount for retained earnings, we're going to show a retained earnings deficit. And in this case, it was for $6,000. So that deficit is going to be a reduction in the total stockholders' equity amount, rather than adding to all of our contributed capital accounts. A deficit is going to be a reduction. So let's keep moving forward. We're now going to look at what we call a stock dividend. A stock dividend is also a type of payment that a corporation can make to their shareholders. However, a stock dividend is not a cash dividend because the payment that they're giving out is not in the form of cash. Instead, they're giving out additional shares of stock. So why would a company do this? Sometimes a company gives out a stock dividend to get additional shares of stock onto the market. When you put additional shares in the market, it makes the price of the stock that's already on the market go down, because with the rules of supply and demand, the more supply, the less the price. So why would you want your stock price to go down? Typically, managers want your stock price to go up, but sometimes they'll want to reduce it to make it more affordable for investors, and then that could create a lot of activity within that particular stock. Also, sometimes stock dividends are issued because a company wants to reward its stockholders, but they don't necessarily have the cash on hand to do that. Another important thing about a stock dividend is a stock dividend doesn't have a big overall effect on the accounting equation. Remember, assets equals liabilities plus equity. A stock dividend is just shifting some classifications within our equity account. So something's moving from retained earnings and into contributed capital. On the other hand, when we had a cash dividend, on the other hand, we did have an effect to the overall accounting equation because we were reducing retained earnings and we were reducing cash. But a stock dividend, on the other hand, it's just shifting within the equity account, not the equity and the assets accounts. So, when we're looking at stock dividends, we have to decide if it is a small stock dividend or a large stock dividend. And the way we determine that is based on the size of the dividend. If the distribution is less than 25% of the previously outstanding shares, we would call that a small stock dividend. If it's larger than 25% of the previously outstanding shares, that would be a large stock dividend. So let me give you an example. To make things easy, we're just going to pretend that we are a company that has 100 shares of stock outstanding. Okay, so 100 shares of stock. 25% of the previously outstanding shares would be 25 shares, because 25% multiplied by 100 shares, 25 shares. So if we had a stock dividend of, say, 20 shares, 20 is less than 25 or 25%, that would be a small stock dividend. But on the other hand, if we had a stock dividend and we gave out, let's say, 50 shares of stock, that would be a large stock dividend because it would be greater than 25% of the shares that were already outstanding. So it's important to understand if you have a small or a large stock dividend, because that is going to affect how we actually record this. Now, if you'll remember, I mentioned just the law of supply and demand. The more supply you put on the market, prices are going to go down because there's more available and it's not going to be at as much of a premium. So when we have a small stock dividend, it's considered small enough that it's not going to have a large effect to the overall market. we're not going to be flooding the market with new shares because it's a small stock dividend. Yes, we're putting some new shares, but we're not flooding the market. On the other hand, a large stock dividend, we consider this to be a huge amount of new stock. And when you flood the market like that, it's hard to know exactly what's going to happen to the price of the stock on the market. You know it's going to probably decrease due to the large stock dividend, but you don't really know how much yet. So keeping that in mind, it's going to change how we record a small versus a large stock dividend. All right, so if you'll remember, I had just said that a small stock dividend is small enough that we don't think that typically it's going to have a very big effect on the overall market. So when we record a small stock dividend, we're going to go ahead and record it at the current market price. And we do that because we're recording this dividend or this liability today, but we're not going to pay it until later. But as soon as we declare this dividend, the market is going to be aware that these new shares are going to be coming onto the market. But because this is a small stock dividend, it's small enough that we think that it's not going to have a big effect on the market value. Therefore, the market value is a reliable amount, and we will record the dividend at market value. Again, this is just for small stock dividends. Alright, so let's work through this. The first thing I want to say is if you're following along with slides that you've printed off, both this example and the next example when we move into a large stock dividend have a typo. This should be $10 par value. I have it correct here, but if you're following along with something you've printed out, you may want to adjust it here just so you don't get confused. So let's get going. We have a company that currently has 10,000 shares of $10 par value stock outstanding. They have decided and have declared a dividend on December 31st, and they're going to have a 10% stock dividend. So they're telling us the percentage here, so we know right away this is a small stock dividend. Therefore, we'll record it at what value? Market value, because we don't think a stock dividend this small is going to have a big effect on the market price of the stock. So at that time, the stock was selling for $15 per share. So here's our market value, and this is the value we're going to record this at. So the stock is going to be distributed on January 20th. Okay, so first we need to make the entry for the date of declaration. This is when we have committed. We now have an obligation. So first thing is first, any type of dividend is a reduction in what? Retained earnings. It's not an expense. So that's what we're going to go ahead and show. We're going to show the reduction in retained earnings here. And then we're going to need to go ahead and have our payable. Now this payable is not cash payable because this is not a cash dividend. Instead, it's going to be common stock distributable, meaning we need to distribute this at some point in the future. So we reduce retained earnings by the market value of the shares that we're going to distribute. If it's a 10% stock dividend on 10,000 shares, that means we're going to be giving away 1,000 shares. 1,000 multiplied by that market price of $15 per share is 15,000. So we're going to go ahead and reduce retained earnings by 15,000 on the date of declaration. Now we need to go ahead and show what we're going to be distributing. What are we promising to give away? And we're promising to give away some stock. So what we go ahead and call this is common stock dividend distributable. This is a type of liability. The only portion that goes into this common stock distributable is going to be $10,000 because that's the 1,000 shares that we're giving away at their par value. So 10,000 is going to go into this common stock dividend distributable. The excess is going to go ahead and go right into paid-in capital in excess of par. Then, when we actually pay this off, when we give out this dividend, we need to get rid of this amount distributable, and we'll look at that. But first, let's look here. This is our stockholders' equity section before we had our stock dividend. So let's look at what's going on here. We've got common stock at $10 par value, and we've got 10,000 shares issued and outstanding. Now they're telling us they could issue 15,000 shares, but they haven't. Right now only 10,000 are outstanding. After this stock dividend, they will then have 11,000 shares outstanding. But right now, before the stock dividend, it's still 10,000. So 10,000 shares, $10 par value. They've got 100,000 in this common stock. They've got some in this paid-in capital in excess of par already. We don't need to calculate that. They're just telling us this here. And then we had 35,000 in retained earnings. So once we have this stock dividend, if you'll remember what happened in the stock dividend, let's go back here. We declared a stock dividend, and it was a reduction in our retained earnings of 15,000. So all we're going to see that happens with a stock dividend, we're not affecting cash, so this isn't going to affect our assets. Instead, it's just going to shift things around in equity. So our retained earnings is going to reduce, but then we're going to see an increase for common stock and then this paid-in capital. So you can see here, this is what we've done. We had our retained earnings reduced by 15,000, so retained earnings after the stock dividend would then be 20,000, and then we'd be increasing our common stock and our paid-in capital by 10,000 and 5,000 respectively. So then when we actually go ahead and we give out that stock dividend, let's look back here. This was still common stock dividend distributable, but now on the actual date when we're making our payment or we're paying out the dividend, we need to go ahead and show that we're getting rid of our liability. That was the common stock dividend distributable. That was a liability that we recorded on the date of declaration, but now on the date of payment, and in this case, remember, we're not paying cash, we're actually paying with extra stock. We now need to get rid of this liability, so we're debiting the liability. And then we're going to show common stock $10 par value, paid-in capital in excess. So here we go. We have now paid it, and we've recorded it as such. Now what happens if we have a large stock dividend? The idea with a large stock dividend, as I mentioned before, is that this dividend is going to put so many additional shares on the market that we expect that the price will decline from its current market value, but we don't know how much it will decline. We can't reasonably calculate that. So what we have to do is, based on the idea of conservatism, we need to go with something that we do know for sure. And what value do we know for sure? We know the par value or the stated value. So a large stock dividend is going to be recorded at the par value or the stated value rather than at the market value. So let's look at this. We have a company, they had 10,000 shares outstanding, $10 par value stock, so the same as before, but now they've declared a 30% stock dividend, so a large stock dividend because it's more than 25%. So how do we record this? 10,000 shares by 30%, that means we're giving away 3,000 shares. Now if you'll remember, on the previous example, they told us that these shares currently had a market value of $15. Because this is a large stock dividend, that $15 market value is irrelevant. We're not going to record it at market value, we're going to record it at par value because that is a value that we can rely on. The market value is no longer reliable because as soon as we declare this, the market is going to reflect that declaration and these prices are going to drop. So what is reliable is this par value because this is a contractual type value. So 3,000 shares at $10 par value, we're going to record this at $30,000. So we're going to go ahead and show the reduction of retained earnings for $30,000 and then common stock dividend distributable for $30,000. We won't have to worry about any type of paid-in capital in excess of par because these are not in excess of par, they are at par value. Then when we actually pay this dividend, we would get rid of this distributable and record it just the same way that we recorded the payment of our small stock dividend. Alright, so now we're going to talk about one other thing that corporations can do as a way to reward their owners. This is called a stock split. Basically, what a stock split, in the most easiest example, we could have a stock split where if someone once had 1 share of stock, after the stock split, they then have 2 shares because it's like they split that 1 share in half. But not only does the share split in half, but also the par value splits in half. So let's look here. We have all of our shareholders, and let's assume that we had a 2-for-1 stock split, meaning for every 1 share you had, you now have 2. These had a $20 par value, and we had 100,000 shares. Once we have this 2-for-1 stock split, we're going to see that they have half of the value. So from $20 par value, they now have a $10 par value, but now you have twice as many. So rather than having 1,000, you have 2,000. Or sorry, instead of having 100,000, you now have 200,000. So in the hands of the shareholders, their overall value is the same because $20 multiplied by 100,000 shares is $200,000. The same as $10 multiplied by 200,000 shares is $200,000. So the value to the shareholders is still the same. You're not hurting them by reducing their par value. Instead, you're giving them twice as many shares. These people are going to be happy that they have more shares because if a company continues to do well, their value will increase twofold because now they have more shares in their hands. So again, this is a type of a way to reward your shareholders. Also, sometimes companies do a stock split when they think that their shares are getting too expensive. So, for example, Apple recently had a stock split after not having one in quite some time. So their stock price had gotten way too high. A lot of people who wanted to invest in Apple simply weren't doing it because they couldn't afford what the stock was selling for at the time. So they had a stock split, and therefore they're reducing that price and making it easier for people to buy. So now we're going to talk about now what we call preferred stock. Preferred stock is simply a different class of stock. It's still stock, it's still a type of contributed capital and goes into your overall equity. So, the difference between preferred stock is that they typically have a priority when it comes to dividends and the distribution of assets in case of liquidation. However, there are also some disadvantages. So even though these preferred stockholders have a priority when it comes to getting dividends, they have a priority, so they get dividends first, but typically the amount that they can get in dividends is limited to a certain amount. Now also with the distribution of assets. So if you'll remember that if we said that a company liquidates, first, the company has to pay off all of their legal obligations. So if you liquidate, you're quitting whatever it is you're doing. So you're going to sell off all your assets. So they sell their assets, and with whatever cash they get, they pay off their legal liabilities. If they had any kind of borrowed money with the bank or any type of note payable or just the typical liabilities, they're going to pay those off. But then whatever is left over in these assets or these cash is then going to go to the owners of the company, so to your shareholders. But who gets that money first? So it's going to go to the shareholders, but your preferred shareholders are going to get their hands on that cash first, and then it's going to go to the common shareholders. However, preferred shareholders typically do not have voting rights, so they really don't have the same type of control that the common shareholders have by being able to vote. So let's begin to look at how some of this works. Now, with preferred stock, we can have 2 types of dividends. We can have cumulative dividends or non-cumulative dividends. Basically what this means, and first I want to state, companies are not required to pay dividends. At least they're not required to pay dividends until they declare a dividend. However, depending on how the contracts for preferred stock are written, their stock can be either cumulative or non-cumulative. So what cumulative tells us is that although a company is not required to pay dividends from year to year, if they don't pay dividends, we're going to begin to accumulate a certain sum each year that is going to get paid to preferred shareholders first, based on the fact that they have not been paid in the past. That seems complicated, but we'll look at it. Non-cumulative means that although if dividends are paid, preferred shareholders will get them first, they are not also going to get dividends in arrears, meaning that if it hasn't been paid in the past was the past and we're starting fresh each year. Whereas cumulative, we're going to count how many years that they have not gotten dividends, and we'll make up for that if and when dividends are paid. So let's look at this. We're looking at the following stockholders' equity section of the balance sheet, and the board of directors declares $5,000 in dividends in 2014. So this is when it's declared. In 2015, the board declared and paid dividends of $42,000. So let's see here. Common stock has a $50 par value and there's 4,000 shares. Preferred stock is 9% stock, and we'll look at what that means. $100 par value, 1,000 shares that are outstanding. So what does all of this mean? If you'll go back a slide, you'll see here that preferred stock typically has a stated dividend rate. And that's what we're seeing over here when we see 9%. What you do is you multiply that 9% by the par value. 9% multiplied by $100 is $9. So if a dividend is paid, they are going to get $9 of dividends per share that they own. Now, it doesn't mean that they have to get it because you're not legally obligated to pay dividends, but if and when dividends are paid, preferred shareholders are going to get $9 for every share that they have. However, let's say a whole lot of dividends are paid, a large sum, they're limited to that $9 per share. So everything in excess of that is going to go to common stock. So in a year when few dividends are paid, preferred stock is going to get them first. Anything left over goes to common. However, if a lot is paid, they're going to be limited to only $9 per share, whereas common stock is going to get everything above that. So we'll look at how these calculations actually happen. But then that's also, while we're talking about this, let's look at cumulative versus non-cumulative. So we're being told that they're paying some dividends in the current years. But let's say that in 2012 and 2013, they did not pay dividends. If these were cumulative dividends, this would mean that each year, $9 for every share would have been accumulating, saying that in 2012 we didn't get paid dividends, in 2013 we didn't get paid dividends, but if we had, I would have gotten $9 for every share during each of those years. So let's say then we do pay dividends in the future. I'm limited to $9 per share, but we also have to make up for the years that have accumulated. So I'll get $9 per share for 2012, $9 per share for 2013, and then for whatever the current year is, so they have accumulated. On the other hand, if they're non-cumulative, that means we forget about the past. If we pay dividends in the current year, you get $9 per share, and that's it. We don't worry about the fact that you haven't gotten it in the past. So let's look here. We have our two different examples. You can see here, this at the top, we're assuming that preferred stock is non-cumulative. At the bottom, this is a totally different scenario, and we're saying that it is cumulative. So what we're looking at is two separate scenarios, and we're looking at who gets a dividend. So let's go back here. In 2014, they declared $5,000 of dividends. Then in 2015, they declared and paid $42,000 of dividends. So in 2014, $5,000 of dividends were paid. Who gets it? if you'll remember, preferred stockholders get dividends first. And they are promised 9% on their shares. So $9 for every share. How many shares are outstanding? 1,000. So they get the first $9,000 of dividends. You can see here $5,000 was all that was paid off. So they're going to get the entire amount and common gets nothing. So then, again, this is non-cumulative. So even though they could have gotten $9,000, they only got $5,000. So that means the other $4,000 of that 9%, they simply do not get. It does not accumulate. So then we start fresh in 2015. 2015, if you'll remember from the previous slide, $42,000 of dividends are declared and paid. Okay? Preferred shareholders get $9,000 and that's it. They are limited to that 9%. And the excess, everything above $9,000 goes to the common shareholders. So the common shareholders get the rest of that $42,000. So they get $33,000. Then let's look at our other scenario, and we're going to assume that preferred stock is cumulative. So 2014, $5,000 was paid out. So preferred, again, gets 100% of that $5,000. Because, again, they're limited to $9,000. But if $9,000 is not paid out, they'll get as much as is paid out. But this is cumulative. So the difference between the $5,000 and the $9,000 that they couldn't get is going to accumulate, meaning when dividends are paid in the future, if there's enough, they will get it. They will make up for what has accumulated. So then in 2015, first we have to look, because this is cumulative preferred stock, at what is in arrears. Arrears is just another way of saying what is owed from the past. We see here that $4,000 is owed because they paid dividends in 2014, but they didn't get the full amount that they are eligible to get. So the first $4,000 is going to go to preferred shareholders for dividends in arrears. And then another $9,000 is going to go to these preferred shareholders for the current year. And then everything left over, and in this case all that's left over is $29,000, that's going to go to the common shareholders. So this is how preferred versus common stock works. As you see, preferred is more likely to get dividends on their shares. So if you're looking at risk and return, preferred is going to get their dividends first. However, because it's a little less risky, you know that you're going to get your dividends first. There's also that chance that your return is not going to be as great because it's going to be limited by the fact that you're limiting your risk, because you can see here in good years, common shareholders are going to get all of that excess. So again, just your basic financial and economic policies. Anytime you're risking money, you're also going to be affecting your return. Greater risk, greater return, or greater possibility of return. So again, something that we can look at with preferred stock, we have to look at participating versus non-participating. So here, participating, dividends may exceed a stated amount once common shareholders receive a dividend that is equal to the preferred stated rate. So what you're looking at here is we said that these preferred shareholders were limited to 9%, meaning no matter how much is paid out, they can't get more than this 9% or $9,000. But if it is participating preferred stock, what they're saying is that preferred shareholders get $9,000, and then common shareholders get $9,000, and once these two are equal, then the two will participate in whatever is left over. However, they don't get above their 9% until common stock has at least gotten an equal amount. Non-participating, on the other hand, is more typical. This is where your dividends are limited to a maximum amount. And that's where we're saying they got $9,000 because that was 9% and that was it. It doesn't matter what common shareholders get, they only get 9%. Moving forward, we're now going to look at treasury stock. I mentioned at the beginning of this chapter that treasury stock is stock that has been issued, but it is no longer outstanding, meaning it's not in the hands of the public. The company has purchased this stock back from the market, and they're holding it as treasury stock. So treasury stock simply represents shares of a company's own stock that has been acquired. So they might do this to use its shares to buy out other companies. They want to avoid a hostile takeover. So this is, say, if one shareholder is accumulating more and more shares. If a company doesn't want that one shareholder or a certain group of shareholders to be able to control the company, they will go ahead and buy back as much stock as they can to make sure that the company holds the majority, so that a particular shareholder cannot make decisions for that company simply because they have the majority or the voting rights. Sometimes treasury, and this is very common, is purchased so that a company can then reissue it to its employees in the form of stock options as a type of compensation. Also, if a market price is dropping and a company kind of wants to prop up the market price, again, anytime you're buying things, taking it off the market, the less the supply, typically that increases the price and the demand. So it's a way to support the market price. This is kind of a gaming type strategy, but it is a reason why companies will purchase treasury stock. So let's look at this. How do we record this? All we're going to do here is to show the purchase of treasury stock. Treasury stock is going to be a reduction in total stockholders' equity on the balance sheet. So let's look at how we do this. So on May 1st, Cyber Inc. purchased 1,000 shares of its own stock on the open market for $11,050. So how do they purchase it? They purchase it with cash. Then we want to show the reduction in equity, and we do that by recording treasury stock for $11,500. If you'll remember, typically when you are issuing stock, you issue stock for, say, cash, just to make it easy. So we debit cash, and then we issue, say, common stock, and you issue that with a credit to common stock. When we do that, that increases the common stock or the equity on our balance sheet. On the other hand, what are we doing here? We're not crediting stock, so we're not crediting equity. We are debiting it. This debit has an opposite effect or a negative effect. So it's going to reduce stockholders' equity on the balance sheet because this is no longer in the hands of the market, it's in the hands of the company. So then what happens if the company then decides to sell this treasury stock? So let's say they've held on to it, they've used it for whatever purpose they wanted, and now they're going to sell it. So when they sell it back, in this case we're selling it for what we purchased it for. So we're going to get cash because now we're selling it. And we need to take that treasury stock off of our books, so we do that here with a credit to net that to zero. So let's look here. Then we have the company, and they're going to sell an additional 400 shares. But they're selling it for $12 per share. So they're selling it for more than what they bought it for. How do we record that? It's not quite as simple. First, we show the cash, $12 multiplied by 400 shares, so we're getting cash of $4,800. But we can only take treasury stock off of our books for what we bought it for. So these 400 shares, we bought them for $11.50 per share. 400 multiplied by $11.50 per share tells us that we need to take $4,600 out of our treasury stock. So we're reducing treasury stock by $4,600. The difference between that is going to be another type of additional paid-in capital, because this is what people out on the market are paying above what you bought it for. So we call this paid-in capital, and we're going to show that it's related to the selling of our treasury stock for more than what we bought it for. So this additional $200 between our original treasury cost and now the market price that we're getting is going to go into this new paid-in capital type account. What happens if we sell it below our cost? So now instead of selling it for more than $11.50, we're selling it for less than that. So in this case, we're selling it for $1.50 less. We're selling it for $10 per share. So our basic entry to sell treasury stock is to show that we got cash and to reduce our treasury stock off of the books for the full amount that we bought it for, $11.50. But what happens when there is a loss is we have to record that loss. Now, if there's a credit balance remaining in treasury stock, we go ahead and record any of that loss in this paid-in capital treasury stock. But once we no longer have a credit balance in treasury stock, we'll have to record the rest of the loss to retained earnings, and you can see that we've done that here. So moving forward, now let's look at the statement of retained earnings. The statement of retained earnings is simply a statement that shows us the total cumulative amount of our net income, minus any net losses if we've incurred losses rather than income, and minus any dividends that have been declared at any point. Now note this says dividends declared. It doesn't matter whether or not they've been paid yet. As soon as they're declared, they are a reduction in retained earnings, and so they should be shown here. Now, throughout the class, we've mentioned this statement of retained earnings, but now we're going to add one additional item that can be shown here, and what we call this is a prior period adjustment. A prior period adjustment is typically when a company has been moving forward, we're in another year, but we realize that there has been some type of major accounting mistake in the past. Now, mistakes happen. Just because you have a mistake, it's not necessarily fraud. Mistakes and frauds are different. But if you do have a type of mistake, you need to report it somewhere. Now, when you close the books at the end of the year, where do you close, let's say, your income statement to? You close income to retained earnings. So you can't go back and adjust income from a prior year. Instead, the way you make that adjustment is by doing it to retained earnings, and we'll show that here. So you can see here we've got our current retained earnings, and then we show that we had some type of prior period adjustment. You need to show what that is, and we'll show it net of any type of income tax benefit that we had. And then we'll show the adjusted amount in our retained earnings based on that prior period adjustment. We then add the current year's net income, or if it had been a loss, we would show that loss. And then we show any type of dividends that have been declared in the current period. And then we'll have our ending balance in retained earnings. Now let's look here at the statement of stockholders' equity. This statement is just going to show you specifically what all makes up what you're seeing in your overall equity statement. So this is going to be more inclusive than the statement of retained earnings. So you're going to be seeing here everything that makes up stockholders' equity. You're going to see your retained earnings, but you're also going to see your various contributed capital amounts. And you can see here common stock shares, the actual amounts for those, and so on. So all of that information is going to be set forward here. You can see the shares, the actual dollar amounts, and it's going to show you any kind of changes that happened to get us from the end of the previous year to the end of the current year. And then in the end, you'll have your total equity amount, and this is going to agree with your balance sheet.